Jai Hind everyone. Welcome to my YouTube channel, which is Explore Yourselves, Banking and General Knowledge, etc. Today I am going to talk about pre-shipment finance, which is export packaging credit, packing credit. Jai Hind everyone. Welcome back to the channel. In today's video, I am going to understand pre-shipment finance, also known as export packing credit, in a very simple and clear way. This is one of the most important topics for exporters, bankers, and anyone working in foreign trade. So let's start from the basics and slowly cover every detail step by step. It is pre-shipment finance or EPC. Pre-shipment finance is a loan given to exporters before they ship their goods from India. This loan helps exporters buy raw materials, process and manufacture goods, pack them, store them, and take care of any working capital expenses needed to complete the export order. The loan is usually based on a letter of credit, a confirmed export order, or any valid evidence showing that a foreign buyer has placed an export order. At the beginning, the loan is normally unsecured because the goods are not yet ready. But once goods are purchased and stored, the bank creates a security charge on these goods through hypothecation or pledge. Types of pre-shipment finance. Pre-shipment finance or EPC can be given in three forms: packing credit in Indian rupees, packing credit in foreign currency (PCFC), or advance against checks or drafts received as advance payment from foreign buyers. These are all used for supporting the exporter before the shipment stage. And receive EPC. Normally, EPC is given to the exporter who has the export order in his name, but there is an exception. Supporting manufacturers or suppliers who do not have export orders in their own name can also receive EPC if they supply goods to merchant exporters or export houses. In cases where manufacturing and exporting is shared between two parties, the pre-shipment finance may be shared between them as per RBI rules. Conditions for granting EPC. The exporter must not be an ECGC specific approval list, which means they should not be on the risky or defaulter list. Export orders can be accepted even they are received through email or fax, provided the message clearly shows the buyer name, goods description, quantity and price, shipment date, and payment terms. The bank must later collect the final export order or letter of credit from the exporter. How the bank disburses packing credit. Each EPC is treated as a separate account. This is done to track the loan more clearly and ensure that money is used properly. Banks can disburse EPC in one single lump sum or in multiple stages depending on production needs. How the bank disburses packing credit. Banks may also open different accounts during manufacturing, such as hypothecations or pledge accounts. Banks must always watch how the funds are being used and whether the exporter is progressing towards shipment. Form of finance. EPC is usually a funded loan, but banks may also give non-funded facilities like domestic or import letters of credit, bank guarantees, which help the exporter procure raw materials. Initially, the loan is unsecured, but once goods are purchased, it becomes secured. Income of finance. The amount of finance should be need based. Banks decide margins based on nature of goods, exporters' capacity, and RBI relaxations. Normally, EPC should not be more than the FOB value or domestic value, whichever is lower. But if ECGC's export production finance guarantee covers the goods, EPC may exceed FOB value, with the condition that the excess amount will be adjusted from incentives like duty drawback. Period of finance. The maximum allowed period for EPC is 360 days. However, banks should give only as much time as the exporter actually needs. If the exporter does not submit export documents within 360 days, the concessional interest rate is cancelled from day one. Extension beyond 360 days needs ECGC approval. Interest rates. Banks can set the exact rate but must follow RBI guidelines. From 2016 onward, EPC is linked to the MCLR system. For MSME exporters, loans are benchmarked to external rates like repo rate, 3-month T-bill yield, or 6-month T-bill yield. Interest rules. Interest at concessional rates is allowed only up to 360 days. If EPC is not liquidated within this period, the entire loan becomes ECNOS, meaning normal higher interest is charged. Maintaining EPC accounts. Each export order must have its own EPC account. RBI also allows running account facility where EPC may be given even before an export order is received under strict conditions. Disbursal monitoring. Banks must ensure funds are used only for export purpose, disburse in stages, and make direct payments to suppliers whenever possible. Trading and follow-up. The goal of EPC is shipment of goods. So banks must closely monitor progress, ensure goods are ready on time, and keep a check on funds usage. Substitution of export orders. If an export order is cancelled, the EPC can be repaid using another export order's proceeds. This is allowed only if the exporter has a good track record, the substitution is genuine, and there is no misuse. Not allowed for sister or group companies. Liquidation, the repayment of EPC. EPC must be repaid from export bills purchased or discontinued, export bills sent on collection, export incentives, undrawn balances, EEFC balances, or rupee resources after export. After shipment, EPC must be converted to post-shipment finance. Otherwise, ECGC guarantee may lapse. Special EPC facilities. There are special EPC schemes for manufacturer suppliers supplying to export houses, sub-suppliers under inland LC system, deemed exporters like World Bank funded projects, goods taken abroad for exhibitions, export of services, construction contractors executing projects abroad, imports meant for export production, exporters of floriculture, grapes, and other agro products, agri-export zone processors, government receivables, duty drawback advances, advances against checks and drafts received as advance remittance. Each of these has its own conditions for interest, coverage, and time limits. Stock inspections and documentations. Banks must ensure that goods purchased with EPC are properly recorded, physically inspected, and match the export order's specifications. Stock statements must be submitted regularly. ECGC cover, WTPCG or ECIB, that is pre-shipment. Banks take ECGC's pre-shipment guarantee which protects them if exporter becomes insolvent or exporter is unable to repay the loan. Certain export categories need a special separate ECGC cover. Disclaimer. This video is made only for educational and informational purposes. The information shared here is based on general guidelines, bank policies, and government rules available at the time of creation. Viewers should not treat this video as financial, legal, or professional advice. Export rules, banking procedures, and guidelines may change from time to time, so please consult your bank, financial advisor, or official government sources before taking any decision. The creator of this video is not responsible for any loss, action, or decision taken by viewers based on this content. Thank you very much for your patience. Request for like, subscribe, and share.